As America, we can finally breathe a sigh of relief. The Federal Reserve has reduced the interest rates by 50 basis points, which is a significant cut, a lot higher than they thought they were going to do. This is the first cut that we've seen, or the reduction, since March of 2020, which we know was the introduction of COVID. So looking at the new target rate, it is 4.75 to 5%. But the problem is, what does this mean for an average American? What things in your life are going to get cheaper, and what things could stay the same or essentially get a little bit more expensive or a little hard to find? That's exactly what we're going to be looking at in this video. Now, of course, prior to Wednesday, it had been 11 consecutive rate increases over the last 10 years to try to tame inflation, which peaked at 9.1%, drove the prices sky high for pretty much everything. When you look at current inflation rate of 2.5, still below the Fed's target of 2, it is getting there, and the Federal Reserve is confident that it is going to do that. Now, the Federal Reserve, it is a dual mandate. There are two things that are controlled and really manipulated by the Federal Reserve. Number one, keeping inflation low. Number two, maximizing sustainable employment. That is right. So the upside risk to inflation has diminished, according to the Fed Reserve Chair, Jerome Powell. And of course, the downside risk of employment has increased, which was the reason for the big decrease when it comes to the interest rates. Now, how much cheaper could it be? This is where it is going to impact you, and impact you really big, because of course, when it comes to lenders, when it comes to financial institutions, just like I work at, it really determines the rate for everything. The Fed's fund rate, or the prime rate, is what is the driving cost, because for businesses, it is really reducing the borrowing cost of money, and it is the cost that is associated with money itself. Now, again, thinking of the first side of this, what is the impact that it is going to have on you with this, in knowing the way that the stock market is going? Credit card rates are going to drop. With a 50 basis point reduction, most credit cards within the next few billing cycles will go ahead and bring these averages down. As it sits up today, credit card averages are 20.78, which is down just a little bit, but we're going to continue seeing this and really pulling it back, which means you're going to have a little bit more room in that budget with a few bucks off of the monthly interest. So even when you're putting more money towards the card, it is going to be paid off exponentially faster, because of course the interest rate is going to be lower. So when you make your regular payment, a majority of it, or not all of it at this point, is going right towards interest. You're going to see less interest. Now, also with auto loans, that's of course when you think of saving a couple bucks here and there. If you're saving a little bit on credit cards, it is going to do the same with auto loans. So at this point, auto loan market has been a little bit more stagnant than they would like to see, meaning that cars are not moving as fast as they would. When you look at the average price of a car around $64K, and you put it at about a 7% interest rate, you are talking about an $800 payment, which is incredible. When that rate starts coming down, that monthly payment, or the monthly liability on that, does come down slightly, which means, again, cutting a 0.5% might not be a game changer for a lot of people. But if you're buying a used car, if you're buying an average, let's say 20, 25,000, 0.5% can make a pretty big difference when it comes to that payment. Now, of course, home equity lines of credit. If you have a home equity line of credit, if you have an interest only, if you have anything that is tied to interest rates itself, you are going to see a reduction. So thinking of a $50,000 home equity, you would see a decrease of about $21 a month. Again, a lot of people think that the 50 basis points is going to be a game changer. It is going to fix all of the woes. It is going to fix all the problems. That, unfortunately, is not true. With the reduction in the basis points, everything systematically is going to get cheaper. So think about the credit card. Let's say you're saving $5 or $10 there. Auto loan that you just purchased or looking to purchase, you're saving 10 or 20 bucks there. Even looking at a HELOC, you're saving about 20, 25 bucks there. Systematically, everything is going to start kind of going downhill with the payments, with actually the interest that you're paying on there. And of course, if you do have an adjustable rate mortgage, the payments will drop slightly as well. Now, mortgage is, of course, a little bit less directly tied to that Fed's fund rate, but overall, they will come down a little bit. Now, when you start thinking bigger picture, at this point, as the economy sits as of 2 days ago, we've seen very, very high rates with CDs. We've seen 5+% interest rates on CDs. They have already started pulling them back. If you look at most of the major financial institutions, looking at your Chase, your Bank of America, your Wells Fargo, most of the CD rates have systematically pulled back. Most of the high yield savings rates have systematically pulled back. And of course, this is completely by design. When they make money cheaper, the banks cannot offer as big or as high as rates that what we've seen, because of course, money is now cheaper. It is not the same that it is. Now, of course, with a lot of bonds, a lot of bills, that will do the exact same. When the rates start going down, they are going to be tied to it, meaning the rates are going to drop. So on one side, if you're a spender, if you have credit card debt, if you have any adjustable debt, you're going to start seeing those payments go down. And the unfortunate side, or the flip side of this, not only seeing things get cheaper overall, is if you're a saver, if you're someone who is sitting on some high yield savings accounts, if you're sitting on CDs, chances are when those come due, you're not going to see those same rates available from financial institutions, because rates, as Jerome Powell has said, are continuing to go down, maybe even another 0.25% this year. But even looking at 2025 after the election, we could see multiple rate reductions going into 2025 until the Fed ultimately gets to their target. So what does it mean big picture when you think of the United States? When you think of our economy in general, making money cheaper means it is cheaper for businesses to borrow. That could be hospitals that are doing renovations, that are buying equipment, that are updating things. It could be building new businesses. It could be startups. There are so many things that essentially become cheaper because the cost of borrowing money is lower, which is, again, the big reason why we do have the Federal Reserve and why they do adjust it. So what that means, though, again, when I think of the investment side, when I think of my ETFs, when I think of everything you have in a 401k portfolio, looking at the S&P 500, it is up almost 20% on the year. This is going to further increase the stock market and increase the value of the stock market, because all of the money we talked about in those high yield savings, in the savings, in those money markets, in those CDs, when they start maturing, and there a lot of them are maturing right now since the rates are no longer there, a lot of that money that is maturing is going to be flowing right into the stock market. You're going to see a lot more in the crypto market, which was up considerably today, looking at Bitcoin, looking at Ethereum. And then, of course, in the stock market itself, it popped about 2% today, which is kind of crazy because, again, a lot more money is going to be flowing into the stock market instead of sitting into all of these accounts when it really is due. And again, credit unions, banks, a lot of things are not going to sit on a ton of money because it doesn't have the value of what they were looking for while they continue to lend. So lending is going to increase. We're going to see more auto loans. We're going to see more home equities. We're even going to see more mortgages that are being signed because rates are starting to actually give a little bit and getting a lot more out of it. So the question is, what does it mean to you? Have you seen anything go down in rates? Have you seen anything go down in price, saving a little bit of money here and there? Me personally, I use M1 Finance, and I do have a link right down below. M1 Finance announced that the high yield savings account went down to 0.5%. The margin borrowing went down 0.5%. So right across the board, we lost the 50 basis points on what we were getting on our savings, but we also lost the 50 basis points that we were getting in the margin if you're looking to borrow money. So it does kind of tumble and go kind of hand over hand when it comes to reducing these. So again, the question is, where have you seen it? Is there a point where you've seen something cheaper? Have you been notified? Are you starting to see a lot of the CD rates and the savings rates kind of drying up? And also, what is the lowest auto rate that you've seen? I know some dealerships are offering some pretty killer rates, including up to 0% interest, but I want to know in your neck of the woods where you're watching what you have seen. And guys, that's going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.